Hey everybody, thank you so much for checking the channel today. My name is Agabus. This is your financial education channel. Today we're taking a look at mortgages, what they are and what some different types of them are. We're going to take a look first and foremost at a fixed rate mortgage, and we're going to use a 30-year mortgage for conversation's sake here. Now, when you take out a mortgage, you're going to go to a bank or a credit union because they're the ones who've got the money. And they're going to give you, let's say, $420,000. That is a current average price of a new build in the United States. But they want to make sure that you're going to pay them back. Of course, you can't pay this back over the next couple of years. So they're going to stretch out these payments over the next 30 years. A 30-year mortgage is the most commonly purchased mortgage from the bank. Now, when you look at a mortgage, of course, they're not going to give you 100% of this. They're probably going to give you some portion of it where you have to create the down payment and they will fund or create the remainder. And so we're looking at a tool today, mortgagecalculator.org. This is not my website. This is not recommendations, and I don't give any sort of support or any sort of recommendations or nothing like this. I'm just a guy on the interwebs. So a 30-year mortgage would be your principal, the amount you take out, stretched out over 30 years, and some interest built into those payments. As you can see here at mortgagecalculator.org, we're going to use the home value of $420,000. We're illustrating a 20% down payment, so you are bringing some money to the closing of the home, and the actual loan from the bank is going to be $336,000, where the bank will give 80%. This type of loan is also referred to as a secured loan, because if you decide to stop making the payments, the bank can always take the collateral or take the home as collateral. So if you decide to skip town, the bank isn't completely out of this money. We're going to use interest rates of 7.77%. That's just the default it creates. I'm sure you can play with some of these numbers here, but we're going to use that for conversation's sake with a start date of April 1st, 30 years. I put property taxes as 1% of the current value. PMI is going to be 0%. This is mortgage insurance. Again, if you decide to skip town, that the mortgage company may have some sort of leeway or some sort of insurance plan against that. You don't have PMI if the value of the house, or I should say, the loan to value of the home is 80% or less. I'm going to throw a number here for home insurance. I use 1% for conversation's sake, and then no monthly homeowners associations. As you can see, the payments that you make, you're going to make payments over time. And with this calculator, it shows the top blue one is going to be your taxes and fees. The interest payments is the lighter blue one here in the middle. And then the principal, the actual paying down of the balance, is this itty bitty one at the bottom here. Most of your payments over the first 15 years or so are going to primarily be interest to the bank. And then you finally start to tack away at the balance of the principal that you took out. But really, if you're going to take a loan out and it's going to be 30 years and you're only going to live there for 3, 4, 5 years, most of your payments are going to go toward the bank. So something to consider. Let's take a deeper dive into what some of these numbers mean. Your monthly mortgage payment from the numbers that we illustrate here is $2,900 and some change, no PMI. You're putting 20% down of the purchase price, which would be $84,000 to bring to closing. And this is another interesting one to notice. The value of the home here is $420,000. The loan amount is $336,000. The total interest that you're going to pay on this is $530,000 and change. And at the end of 30 years of all the payments you have paid back, the total payments for this home is going to be over $1 million. There is something to be said about making some additional payments toward the principal to save a little bit on that interest payment. There's other tools you can use online when it comes to showing how quickly you can pay off the loan. As much as I'm not a fan, Dave Ramsey does have a pretty good tool to use online. So I showed here the original loan value of $420,000, 30-year payments. And if you make just a little bit extra every month, let's add, say, $100 a month for the next 30 years, you can see that the loan is now paid off within 3 years, 3 years faster, which doesn't seem like too much, but you can play with some of these numbers here. Now, a lot of folks will recommend that you try to make one extra payment a year toward the principal. So if you make 12 payments toward the mortgage, you make one extra one that goes directly to the principal balance. So in this illustration, they will show $3,000 a month for the payment. Couldn't tell you why it's different, but for illustrative purposes only, let's throw in one extra yearly payment of $3,000, and you can see that it paid off much faster with 6 years. Now, when it comes to saving interest, it makes a bit of sense to pay some more toward the principal. However, if you're trying to pay the mortgage off sooner or quicker, the question really is, what is the interest rate on the mortgage? The higher the interest rate, the way more it makes sense to make those extra payments to pay that thing off. It's really going to make dividends in the long term. But with some really low interest rates like we had kind of in the 2s and 3s not too long ago, I don't know if it would really make a lot of sense to make those extra payments versus putting that money towards something else. Now we're going to take a look at a different type of a mortgage. This is called an adjustable rate mortgage, where you start off with the current interest rates, and then as interest rates change, so does the monthly payment on the mortgage change. So for illustrative purposes only, we're going to use the same mortgage amount as before, 30 years at 7.77%. And you can play with the interest rate here a little bit to see what the monthly payment would be as interest rates start to change. And you can see when interest rates go up, the monthly amount does change pretty significantly here. So generally, I would caution folks when it comes to an adjustable rate mortgage, unless you are very attuned to what the worst case scenario might be, and you are following the central bankers very closely to see what they plan to do with raising rates, because when it comes to interest rates, they are the masters. And the last type of loan we're going to take a look at is a second mortgage, sometimes called a home equity line of credit. This one does get some people into trouble. So if you already own a home, you already have a mortgage, and you want to tap into the equity inside of the home, you can go to a bank or credit union, take out a home equity line of credit, and in some ways it's kind of like a credit card, if you would. You can tap into it, pay it off, and tap into it and pay it off. The interest rates normally are adjustable, or they're variable. You can get fixed, but generally speaking, they're adjustable. And where people get really into trouble is when they look at the monthly payment versus the monthly payment plus what they need to pay off the loan. Because you see, home equity line of credits usually are interest-only payments first. So if you ran through a rough calculator and you found out how much you needed to pay, it may not be the actual payment that you need in order to pay the home equity back. Minimum monthly payment is usually only interest. And if you only pay the minimum, which is only interest, you will probably never pay this thing off. Some banks may, at the end of 5 years or 10 years, take the outstanding balance and turn that into a fixed mortgage with a fixed payment so that they can actually get their money back. You do have to be careful with these home equity line of credits. They're great to tap into the equity, but if you're only paying interest only, you're never going to pay those things off. That's all I've got for today. I hope you enjoyed the information. And if you did and you want to support the channel, all you need to do is hit the like button below, subscribe if you want to see more content, and hit the bell notification so you get notified every time I upload content. Drop a comment in the comment section below if I missed anything, if I was wrong on anything, if I need to adjust any of the information. Please give me feedback. I can always improve this channel. As always, stay inquisitive, stay informed, and stay subscribed for more. We will see you next time.